Welcome back to the deep dive. Today we're tackling a topic that, well, it touches almost every Canadian who dreams of owning a home, or maybe already does.
Mortgages.
Exactly, mortgages. It's a huge subject, often seems full of jargon, but it's so crucial to understand.
Mm,
Our goal today isn't just, defining terms. We want to really get under the hood of Canadian mortgages, explore how they work, why certain choices matter.
absolutely. We've sifted through a pretty comprehensive guide to pull out the core knowledge you really need.
Okay.
So whether you're maybe actively looking to buy your first place, or perhaps navigating a renewal, or even if you just want to understand this cornerstone of Canadian finance better,
Yeah.
we're here to make it digestible. And hopefully, maybe even a little surprising. We'll look at everything from the fundamental building blocks right through to the different types you might see.
Okay, let's dive right in then. At its most basic level, a Canadian mortgage is a loan, a really significant one that you get from, say, a bank or a credit union to help you buy property. Now, what really sets a mortgage apart is that it's secured by the property itself.
That's the key point.
Think of it like this. You're telling the lender, look, I want this house. I promise I'll pay back the money. But if I don't,
If I don't keep that promise,
you have the legal right to take the house. That security, that's really the bedrock of how mortgages function.
that's a perfect way to put it. And this security, it's formalized through a pretty detailed contract.
Right.
This contract spells out exactly how much money is borrowed. That's the principal.
Yeah.
The cost of borrowing it, which is the interest rate, the repayment schedule, and, various other conditions.
Mm-hmm.
And because the lender has this tangible asset, the house, backing the loan, it really reduces their risk.
Which is why the interest rates are usually lower than, say, a credit card.
Exactly. Lower than unsecured loans like a personal line of credit or a credit card for sure. That security makes a big difference.
Okay, so let's break down those core components you mentioned. First up is the principal. What exactly are we talking about here?
Okay, simple terms. The principal is just the original amount of money you borrow to buy your home.
Right.
It's calculated as the total purchase price of the property minus the down payment you put in from your own fund.
Okay, give us an example.
Sure.
Yeah.
Let's say you're buying a condo. Maybe it's $600,000. And you've saved up $120,000 for the down payment,
Right.
your principal mortgage amount. That'd be $600,000 minus the $120,000. So $480,000. That's your starting loan amount.
$480,000. Got it.
Now, something important to keep in mind. If you need mortgage default insurance, and we'll definitely talk more about that later, the premium for that insurance,
Yeah.
sometimes that can actually be added right onto this initial principal amount.
Oh, interesting. So it increases the loan.
Exactly. It increases the total you're borrowing and, crucially, the amount you're paying interest on right from the start.
Okay, principal. The initial chunk of money borrowed. Next, interest. We all know it's the cost of borrowing, but how does it specifically work with a mortgage?
Well, interest is basically the lender's fee, right? Their charge for letting you use their money to buy your place.
Mm-hmm.
It's always expressed as an annual percentage rate, the APR, annual interest rate. Think of it like rent you pay on the money you've borrowed.
Rent on the money, I like that.
Yeah. And every single time you make a mortgage payment, a part of that payment goes towards covering the interest that's built up since your last payment.
On the remaining balance.
Exactly. On the outstanding principal balance, the part of the original loan you still owe at that point.
So it follows then that a higher interest rate really impacts how much we end up paying overall, right?
Oh, absolutely. Massively.
Yeah.
A higher interest rate means a bigger slice of each payment goes to interest.
Okay.
And over the entire life of the mortgage, you'll end up paying significantly more in total interest. It really adds up.
So using that $480,000 example, if the rate was, say, 6%.
Right? With a $480,000 mortgage at 6%, a larger chunk of every monthly payment is just covering that 6% annual cost, calculated on whatever principal you still owe.
Makes sense.
And it's also worth just briefly mentioning. In Canada, mortgage interest is calculated using something called semi-annual compounding.
Semi-annual compounding. Okay, sounds technical.
It is a bit, yeah. Basically, it means the interest is calculated based on the rate twice a year, not monthly. We can dig into the nitty-gritty later, but for now, just know it slightly affects the total interest paid compared to, say, monthly compounding.
Okay, good to flag. So we have the amount principal and the cost interest. Now, what about the amortization period? That sounds very official.
It does sound formal, doesn't it?
Yeah.
But think of the amortization period simply as a total length of time you have to completely repay your entire mortgage.
The whole thing, principal and interest.
The whole shebang. Principal plus all the interest that accumulates over that time. It's the complete lifespan of your mortgage loan.
Okay.
From day one until you make that very last payment and the balance hits zero.
And what's typical in Canada?
Very common is 25 years. That's sort of the standard benchmark you hear a lot.
25 years. Can it be different?
Oh, definitely. Depending on the mortgage type and the lender, you might get shorter periods, maybe 15 or 20 years. Or you could have longer ones.
Longer? Like how long?
Well, especially with conventional mortgages, you might see up to 30, maybe even 35 years in some cases.
Wow. So if I choose a longer time to pay it back, say 30 years instead of 25, what's the catch? Lower payments, I assume.
Exactly. That's the main appeal. A longer amortization means you're stretching the payments out over more months. So each regular payment is lower.
Makes it easier month to month.
For sure. It can make homeownership seem more immediately affordable, easier on the budget.
Yeah.
But
There's always a but.
there's always a but.
Yeah.
Because you're taking longer to pay off that original loan.
Mm-hmm.
Interest keeps adding up for a longer time. So the result is you end up paying significantly more total interest over the entire life of that mortgage. A lot more sometimes.
Okay, so longer amortization, lower payments now, but much higher total cost later.
You got it. And the flip side.
Yeah.
Shorter amortization, say 15 or 20 years, means higher monthly payments, obviously.
Right, squeezing it into less time.
But the big win there is you save a considerable amount on total interest paid over the long haul. And, of course, you own your home free and clear much sooner.
That makes sense. Now, I think I remember hearing something about rules. Like how long you can take to pay depends on your down payment.
You're absolutely right. There are different rules depending on whether you have what's called a high-ratio mortgage or a conventional one.
Okay, define those quickly.
Sure. High ratio means your down payment is less than 20% of the home's price. Conventional means your down payment is 20% or more.
Got it. So for high ratio, less than 20% down, what's the amortization limit?
Traditionally, the maximum amortization for high-ratio mortgages has been capped at 25 years. That was the standard.
Okay.
However, there's a pretty significant recent change here.
Oh, do tell.
As of December 15, 2024, first-time home buyers.
Just first-time buyers?
Yes, specifically first-time home buyers who are purchasing any type of home, doesn't matter if it's brand new or resale, they can now qualify for an amortization period of up to 30 years on their high-ratio mortgage.
Wow, okay. That's a big shift from 25 years.
It really is. Previously, that 30-year option for first-timers was only for newly constructed homes. This expansion aims to help with affordability, make those initial payments a bit more manageable for people getting into the market.
That could make a real difference for some buyers. And for conventional mortgages, with 20% or more down.
With conventional, because the lender sees less risk with that bigger down payment, you generally have more flexibility. Lenders are often willing to offer amortization periods up to 30 years, sometimes even 35, depending on their specific policies.
Okay, that recent change for first-time buyers is definitely good to know. So that's the amortization, the total repayment journey. Now, let's talk about the mortgage term. It sounds similar, but I gather it's different.
It is different, yes. Think of the amortization as the entire marathon, like we said. The mortgage term is more like one specific leg or lap of that marathon.
A shorter segment within the bigger picture.
Exactly. The mortgage term is the length of your current specific contract with your lender.
Okay.
During that term, you have a locked-in interest rate. It specifies the lender you're with, and it outlines any particular conditions or features of that specific agreement.
And how long are these terms typically?
They can vary quite a bit in Canada. You might see terms as short as 6 months or maybe a year, or they could be as long as 7 or even 10 years.
Oh, what's common?
By far, the most popular choice for Canadians tends to be the 5-year term.
Okay, 5-year term is common. So what happens when my 5-year term ends? Does the mortgage just vanish?
Not usually. Unless you had a really, really short amortization period to begin with, you'll almost certainly still have an outstanding balance remaining on your mortgage when the term ends. So at that point, you have a couple of choices. You either need to renew your mortgage, or you need to pay off the entire remaining balance in one go.
Renew. What does that involve?
Renewing basically means you negotiate a new deal for another term. You'll get a new interest rate, maybe tweak some conditions. You can do this with your existing lender.
Or switch.
Or you could shop around and switch to a different lender if they offer you a better rate or terms that suit you better.
So most people go through this renewal process several times.
Oh, absolutely. Most Canadian homeowners will have multiple mortgage terms, each potentially with a different rate, maybe even a different lender over the course of their full 25 or 30-year amortization period.
Yeah.
It's like renegotiating the lease on your loan every few years.
Renegotiating the lease on your loan. That's a good way to think about it. Okay, makes sense. Moving on to the down payment. This is the money we all stress about saving up, the cash we pay up front, right?
That's the one. The down payment is simply the portion of the home's total purchase price that you pay using your own money right at the time you buy.
Where does it usually come from? Savings.
Typically, yeah. Savings, maybe investments you cash in, or sometimes it can be a financial gift from, say, a family member. That's quite common, too.
And lenders require a minimum amount, don't they?
They do. In Canada, there are minimum down payment rules, and the exact percentage depends on the purchase price of the property.
Okay, break that down for us.
Sure. For homes priced at $500,000 or less, the minimum down payment is 5%.
5%.
For homes priced between $500,001 and $1 million,
Yeah.
you need 5% of the first $500,000 plus 10% of the portion of the price that's above $500,000.
Okay, a bit more complicated there.
A little bit, yeah. It's a tiered system. And then for homes priced over $1 million,
Over $1 million.
the minimum required down payment is a flat 20%.
20% mandatory over $1 million.
Yeah.
Got it. And why is putting down a bigger chunk initially, more than the minimum, generally seen as a good idea?
Well, there are several pretty significant advantages. First, and most obviously, it directly reduces the principal amount you need to borrow from the lender.
Less debt from the start.
Exactly. Smaller loan means you're paying interest on a smaller sum right from day one and throughout the mortgage.
Which means less total interest paid.
Precisely. Because you borrowed less overall, you'll generally pay less total interest over the entire life of the mortgage. That saves you real money in the long run.
Makes sense. Any other benefits?
Yes. As we'll get into more detail soon, the size of your down payment is the key factor in determining if you need to pay for that mortgage default insurance. A larger down payment, specifically 20% or more, helps you avoid that potentially significant extra cost.
Ah, right, avoiding the insurance.
And finally, just having more equity in your home from the beginning, owning a bigger slice of it outright, generally puts you in a stronger financial position overall, more security.
Okay, that makes a lot of sense. Last one in our core components list.
Yeah.
The loan-to-value ratio, or LTV. This sounds like another one of those key numbers lenders look at.
It absolutely is. The loan-to-value ratio, or LTV, is a really important risk assessment tool for lenders.
Risk assessment. How so?
It basically calculates how much you're borrowing compared to how much the property is actually worth.
Okay.
Specifically, it compares the mortgage loan amount to the value of the property. And that property value is usually taken as the lower of either the price you agreed to pay or the value determined by a professional appraiser.
Lower of the purchase price or appraised value. Got it.
And it's a percentage.
Yes, it's expressed as a percentage. The formula is pretty simple. You take the mortgage amount, divide it by the property value, and then multiply by 100%.
Okay, let's use our example again. We had a $480,000 mortgage on a $600,000 house. What's the LTV there?
Right. So that would be $480,000 divided by $600,000.
Which is 0.8.
Exactly, 0.8. Multiply that by 100%, and you get an LTV of 80%.
80% LTV. And why is this particular percentage, 80%, so important for us to know?
That 80% mark is the magic number, really. It's the primary way lenders categorize mortgages into those two main types we mentioned earlier, high ratio and conventional.
I can expect to the down payment types. Directly. A high ratio mortgage is any mortgage where the LTV is greater than 80%. This automatically means your down payment was less than 20% of the home's value.
Okay. LTV over 80% is high ratio.
And a conventional mortgage is one where the LTV is 80% or less, which means mathematically you must have put down at least 20%.
LTV 80% or lower is conventional.
Right. And this distinction is incredibly important because, as we've hinted, it directly determines whether or not you'll be legally required to purchase that mortgage default insurance.
Right. The insurance that protects the lender if I can't make my payments.
Yeah.
Okay, so we've really unpacked the fundamental building blocks now. Principal, interest, amortization, term, down payment, and LTV. That's a lot.
It is, but they all fit together.
Yeah. So now let's get into the mechanics of those regular payments we make. I know some goes to the loan amount, some goes to the interest cost. How does that actually work, payment by payment?
That's a great way to think about it. In Canada, the vast majority of home mortgages use what are called blended payments.
Blended. Meaning?
Meaning that each regular payment you make, whether it's monthly, which is most common, or maybe biweekly or weekly, it includes both a portion that goes towards paying down the principal balance
Okay.
and a portion that covers the interest that's accrued since your last payment.
Both in one payment.
Both in one payment.
Okay.
And for the most common mortgage types, especially fixed-rate mortgages where your interest rate is locked in for the whole term,
Yeah.
the total dollar amount of this blended payment usually stays exactly the same for that entire mortgage term.
Oh, okay. So predictable payments each month.
Exactly. That predictability is a big plus for budgeting. Your total payment amount doesn't change during the term.
I've heard that in the early years, most of my payment is just interest. Is that really true? And why does it change over time?
You've heard correctly. That's absolutely true.
Yeah.
In the initial years of your mortgage, think about it, your outstanding principal balance is still really high, right? You haven't paid off much yet.
Makes sense.
So, because interest is calculated on that large remaining balance, a bigger percentage of your fixed monthly payment has to go towards covering the interest cost.
So only a small bit chips away at the actual loan.
Exactly. Only a smaller portion of that payment actually goes towards reducing the principal amount you originally borrowed in those early stages.
Huh. So in a way, the bank gets more of the money I pay at the start.
Well, in terms of where your payment is allocated, yes, a larger share goes to cover the interest cost initially. But here's the key part.
Okay.
As you keep making those regular payments, even that smaller principal portion starts to chip away at the balance. So the outstanding principal gradually decreases.
Right. Slowly but surely.
Slowly but surely. And because the principal is going down, the amount of interest that accrues each month also starts to go down. Because remember, interest is a percentage of the remaining balance.
Ah, okay. Less balance, less interest charge.
Precisely. So as the interest portion needed for your fixed payment gets smaller, more of that same fixed payment amount automatically gets applied to the principal.
So it shifts over time.
It's like a seesaw. With each payment you make, a progressively larger share goes towards paying down your principal, and a progressively smaller share goes to interest.
So you start off paying mostly the cost of borrowing.
Right. And over time, more and more of your payment goes directly towards actually owning more of your home, building up your equity faster.
That makes a lot more sense visually, thinking of it shifting like that. Could we maybe walk through a simplified example to really see it?
Absolutely. Let's stick with our $480,000 mortgage example. Let's say it's at 6% interest again and a 25-year amortization.
Okay.
Now, the calculations get a bit complex, but hypothetically, that might result in a monthly payment of around, say, $3,095, just for illustration.
Okay, about $3,000 a month.
Right. Now, for your very first monthly payment on that loan,
Yeah.
a really big chunk, something like $2,400, would just be the interest calculated on that initial $480,000 principal.
Wow. $2,400 interest out of $3,095.
Exactly. Leaving only about $695 that actually goes towards reducing the principal balance in that first payment.
Okay, so yeah, mostly interest at the start.
Definitely. Now, let's jump forward quite a bit. Let's look at, say, your 120th payment. That's 10 years into the mortgage.
10 years in, how does it look then?
Well, you'll see the breakdown has shifted significantly. By payment 120, maybe around $1,900 of your $3,095 payment might be going towards interest.
Still a lot, but less than $2,400.
Right. And that means about $1,195 is now being applied to reduce the principal.
Ah, so almost double the principal reduction compared to payment one.
Exactly. You can clearly see how much more of your payment is actively working to decrease the loan amount you owe by that point.
And way down the line, like the very last payment.
Right. If we looked at the very end, say payment number 300 in this 25-year scenario, almost the entire $3,095 payment would be principal, maybe just a few dollars of interest left. And that final principal payment brings your mortgage balance down to zero.
That really paints a picture of how that balance flips over the whole life of the mortgage.
It really does. Now, it's super important to remember these numbers are simplified, right? Just for illustration.
Okay.
The actual calculations lenders use involve that semi-annual compounding we mentioned, which makes the real numbers slightly different, a bit more complex.
So where can people get the real numbers for their situation?
For anyone who wants to see a super detailed payment-by-payment breakdown, what's called an amortization schedule, tailored to their specific loan amount, interest rate, amortization.
Yeah.
The Financial Consumer Agency of Canada, the FCAS, has a fantastic online mortgage calculator on their website.
FCC calculator.
It's a really valuable tool. You plug in your numbers, and it shows you exactly where your money is going with each and every payment over the entire loan. Highly recommend checking it out.
That sounds incredibly useful. I'll
Mhm.
definitely look that up. And I'm guessing those total monthly payments can sometimes include more than just the basic principal and interest.
Yes, that's correct. While P&I, principal and interest, is the core, your total payment to the lender might bundle in other things.
Like what?
Well, sometimes optional items. Like you might choose to include mortgage life insurance premiums in your payment.
The insurance that pays off the mortgage if you pass away.
Exactly, protects your family. That's often an option. Also, many homeowners arrange for their lender to collect property taxes along with the mortgage payment.
Oh, the lender handles the property tax bill.
Yeah, they collect a portion each month, hold it in what's called an escrow or tax account, and then they pay your property tax bill to the municipality directly when it comes due.
Convenient, I guess.
It can be, but those extras, like insurance or taxes, would obviously increase your total monthly outlay beyond just the base principal and interest.
Right. Okay, so we're making these payments, slowly building equity, but we started this whole chat emphasizing that a mortgage is secured. Let's circle back and dig deeper into the property as collateral. What does that really mean in practice?
This is such a foundational point. It truly defines what a mortgage is, the fact that it's secured by the actual real estate you're buying. That's what gives the lender the confidence, the assurance, to lend such large sums of money, often at those lower interest rates we talked about.
So my house isn't just my home.
Legally, it's also the lender's security blanket for the money they've lent you. It's performing a dual role, really.
Okay. And how does the lender actually formalize this claim? How do they make it official?
They do that by registering what's called a mortgage charge or sometimes a lien against the title of your property.
A charge or a lien on the title? Okay.
Think of it like a formal legal IOU that's officially attached to your property's ownership documents in the public record.
Public record. Where?
This registration happens at the relevant provincial or territorial land registry office. It makes it publicly known that this lender has a legal claim or interest in your specific property.
And that gives them rights if something goes wrong.
Precisely. It ensures they have a legal right to take action concerning the property if certain conditions of the mortgage agreement aren't met by you, the borrower.
And the main condition is making the payments on time, right? But what happens if, heaven forbid, someone doesn't meet those obligations? What can the lender actually do?
You're right. Failing to make the agreed-upon payments is the most common reason for default. But other things could trigger it too. Like maybe failing to pay your property taxes or letting your mandatory home insurance lapse. Those are usually also conditions in the mortgage contract.
Okay. So if any of those happen, the borrower is in default. Then what?
If a borrower defaults, the lender has the legal right to step in and try to recover the outstanding debt.
Ow.
Typically, this involves starting a legal process to take possession of the property.
Take the house back.
Essentially, yes.
Yeah.
And then they sell it to try and recoup the money they are owed.
Wow. What's that process called?
The specific legal procedures are generally known as foreclosure or power of sale.
Foreclosure or power of sale. Is there a difference?
Yes, the exact process, the steps involved, and the timelines can vary quite a bit depending on which province or territory the property is in, and also based on the specific wording in your mortgage agreement.
Okay. So it's complex.
It is. We're actually planning to dedicate a future deep dive specifically to unpack the details of foreclosure and power of sale because it's so important. But for now, the key takeaway is understanding that this is the lender's ultimate legal backup plan to protect their investment if things go seriously wrong.
That definitely hammers home the seriousness of the commitment, doesn't it? Okay, so that's the scary part. What about the good part? When the mortgage is finally completely paid off, does that lien or charge just disappear?
Not quite automatically, no. Once you've made that very last payment and you've met all the other terms of the contract,
You're finally free.
you're free of the debt.
Yeah.
But you still need to go through a specific legal step called the discharge of mortgage.
Discharge of mortgage.
Yes. It's the official procedure to legally remove the lender's claim, that charge or lien, from your property's title.
Clears the record.
Exactly. It clears the public record, officially showing that you now own your property free and clear, with no mortgage obligation tied to it anymore.
Is there a cost to doing that?
Usually, yes. There are typically administrative fees charged by the lender, and sometimes legal fees involved as well, depending on your lender and your province. It's a final administrative hurdle.
Okay, good to know about the discharge process. Now, I've definitely heard the term collateral mortgage thrown around. Is that different from just the basic idea that my house is collateral? It sounds maybe more complicated.
That's an excellent question. And yeah, the terminology can be a bit confusing here.
Yeah.
You're totally right that in the general sense, all mortgages use the property as collateral. That's the fundamental nature of a secured loan.
Right, that's what makes it a mortgage.
Exactly. However, a collateral mortgage also refers to a specific type of mortgage product that some lenders offer.
A specific product. How is it different?
With this specific collateral mortgage product, the lender registers a mortgage charge on your property title, but the amount they register can actually be higher than the amount of money you're initially borrowing.
Higher. Why would they register for more than they lent me? Like, how much higher?
It could be significantly higher. For example, they might register a charge for, say, up to 100% or even 125% of the property's current value, even if your initial loan is only, say, 70% of the value.
125%. Why on earth would they do that? What's the point?
The main reason lenders offer this is to make it potentially easier and maybe cheaper for you to borrow more money against your home equity later on.
How so?
Often, these collateral mortgages are linked with a home equity line of credit, a HELOC,
Yeah.
because that higher mortgage charge is already registered on title.
Yeah.
You might be able to access additional funds drawing on your HELOC up to that higher registered limit without needing to go through the whole process and cost of registering a brand new mortgage charge each time you want to borrow more.
Ah, so it pre-approves a higher borrowing limit against the house.
In a way, yes. It potentially streamlines future borrowing against equity.
Okay, sounds convenient for borrowing more later. Are there any, downsides or catches to be aware of with these collateral mortgage products?
There can be, yes. While it offers potential convenience for future borrowing, one significant thing to consider is switching lenders.
Switching at renewal time.
Exactly. It can sometimes be more complicated and potentially more expensive to switch your mortgage to a different lender if you have a collateral mortgage.
Why is that?
Because of how that higher charge is registered, a new lender might require you to fully discharge the entire existing collateral mortgage from the old lender before they can register their new standard mortgage.
And that discharge costs money.
That discharge process often involves legal and administrative fees that you might not face or might be lower when switching a standard non-collateral charge mortgage.
Okay, so potentially stickier to leave your current lender. Anything else?
Some financial experts also raise concerns that having that higher registered amount could, in theory, give the original lender more leverage or potentially complicate other financial arrangements down the road, although that's debated.
Seems like something to understand fully before signing up.
Definitely. We're planning another deep dive specifically on collateral mortgages as a product, looking at all the pros and cons in detail. But for today, the key is just understanding that difference.
The difference between the concept of property as collateral for all mortgages
And the specific product called a collateral mortgage with that higher registered amount. They're not the same thing.
That distinction is really helpful, actually. Clears things up. So just to wrap up the section on collateral, the fact that our house secures the loan is absolutely fundamental. It often gets us better interest rates.
Right, reduced risk for the lender.
But it also carries that very significant risk, losing the home, if we don't uphold our end of the deal.
Precisely. It's the core trade-off.
Yeah.
And it really underscores why borrowing responsibly is so critical. Meaning, borrowing an amount you know you can comfortably repay, month after month, year after year, really understanding all the terms and conditions in that mortgage contract before you sign, and being fully, soberly aware of the serious consequences if you default.
Absolutely crucial advice. Okay, we've built a really solid foundation now, I think. We understand the core mechanics, the security aspect. Let's shift gears now and talk about the different types of mortgages available in Canada. I know they'd be sliced and diced in different ways, but one of the most basic splits seems to be based on that down payment size we discussed.
That's absolutely right. The Canadian mortgage landscape is, well, it's pretty diverse. There's a wide range of products designed for different folks, different financial situations, different goals. And arguably the most fundamental way mortgages get categorized right off the bat is based on how much you put down initially, that down payment percentage.
Right.
That number is the key decider between whether you have a conventional mortgage or a high ratio mortgage. And that classification, as we've touched on, has huge implications for things like needing insurance and potentially other loan features too.
Okay, so let's tackle conventional mortgages first. What's the defining feature? What makes a mortgage conventional?
Simple definition. A conventional mortgage is one where your down payment is 20% or more of the property's value, the lower of purchase price or appraised value.
20% or more down.
Right, which, going back to our earlier point, means your loan-to-value ratio, LTV, is 80% or less. You've got a pretty solid equity stake in the home right from the start.
And because I've put down that bigger chunk of my own cash, does that usually mean I get to skip the mortgage insurance?
Generally, yes.
Yeah.
That's one of the main benefits.
Yeah.
Because you've shown you could save a significant amount and you have that 20% plus equity buffer.
Yeah.
Mortgage default insurance, often called CMHC insurance, though private insurers like Sagan in Canada guarantee offer it too, is typically not required for conventional mortgages.
It's not required.
Okay.
Lenders usually feel that the larger down payment gives them enough protection against potential losses if you were to default.
Are there ever exceptions? Could they still make me get insurance?
It's rare, but yes, there can be exceptions. A lender might still require some form of insurance, or perhaps apply stricter qualifying rules in certain specific cases. For example, if maybe you're self-employed with less predictable income, or if your credit history isn't perfect. But for most borrowers with 20% plus down, no insurance is the norm.
Okay. What about the amortization period for conventional mortgages? Are those longer repayment times, like 30 years, more available?
Yes, that's often another advantage. With conventional mortgages, lenders are generally more flexible and comfortable offering longer amortization periods.
So 30 years is common, maybe even longer.
You'll definitely find 30-year options readily available from many lenders. And depending on the specific lender and their policies, sometimes even 35 years might be possible, though maybe less common.
Right. And we know longer amortization means lower payments. Lower regular payments, yeah. Which helps with monthly cash flow. But of course, more total interest paid over the long run. That trade-off again.
Always the trade-off. Now, what about the actual interest rates themselves on conventional mortgages? Since the lender doesn't have that insurance backing, are the rates typically higher or lower?
Okay, this might seem a bit counterintuitive at first.
Yeah.
But because the lender is technically taking on slightly more direct risk themselves, even though your LTV is low, they don't have that third-party insurance guarantee. Conventional mortgages often come with slightly higher interest rates compared to an equivalent high-ratio insured mortgage.
Wait, higher rates even with a big down payment? That seems backward.
It does, doesn't it? But think about it from the lender's perspective. For a high-ratio mortgage, if the borrower defaults, the insurer steps in and covers the lender's losses. That insurance makes the loan very low risk for the lender.
Ah, okay. The insurance makes the high-ratio loan safer for the bank.
Exactly. And that reduced risk for the lender on an insured mortgage can sometimes translate into a slightly lower interest rate being offered to the borrower compared to a conventional mortgage where the lender bears the default risk directly.
That is interesting. Okay. And finally, for conventional, are there any restrictions on the price of a property I can buy?
Generally, no upper limit, as long as you can come up with that required minimum 20% down payment.
Okay.
However, there's a very important rule regarding higher-priced homes. For any property being purchased for $1.5 million or more.
$1.5 million.
Yes, $1.5 million or more. A conventional mortgage requiring that minimum 20% down payment is mandatory. You cannot get a high-ratio insured mortgage on properties at or above that price point.
And that $1.5 million limit, that's relatively new, isn't it? It used to be lower.
That's right. The threshold was increased from $1 million effective December 15th, 2024. So if you're shopping at that higher price range, you absolutely need to factor in saving up at least 20% for the down payment. No high-ratio option available.
Okay, good to know. That wraps up conventional. Now let's flip to the other side. High-ratio mortgages. These are the ones where the down payment is less than 20%, right?
Exactly. A high-ratio mortgage is what you get when your initial down payment is less than that 20% benchmark of the property's value.
Meaning the LTV is over 80%.
Correct. LTV is greater than 80%. And this is a really common scenario, especially as you might expect for first-time homebuyers who maybe haven't had decades to save up a huge down payment.
Right. And this is where that mandatory mortgage default insurance automatically kicks in.
Yes, this is the key difference. Under Canadian regulations, if you have a high-ratio mortgage, less than 20% down, you are required by law to obtain mortgage default insurance. No way around it.
And that insurance, again, it protects the lender, not me.
Correct. It's crucial to understand that. The insurance protects the lender if you default and they lose money. It's provided by the Canada Mortgage and Housing Corporation, CMHC, that's the government agency, or by one of the approved private insurers, Sagan or Canada Guarantee.
And I, the borrower, have to pay for it. How does that work?
Yes. The cost of the insurance premium is borne by you, the borrower. It's calculated as a percentage of the total mortgage amount, and the percentage rate actually varies. It gets higher the smaller your down payment is, or the higher your LTV.
So less down means a higher insurance premium rate.
Generally, yes. And typically, you don't pay this premium up front in cash. Instead, it's usually added right onto your principal mortgage balance.
Added to the loan, so I pay interest on the insurance premium too.
Exactly. You end up financing the insurance cost over the entire life of your mortgage, paying interest on it along the way. That's why it adds a significant cost compared to a conventional mortgage.
Okay, mandatory insurance added to the loan. What about the amortization period for high ratio? Is it generally shorter?
Historically, yes.
Yes.
The maximum amortization allowed for high-ratio insured mortgages was typically capped at 25 years. That was the rule for a long time.
But you mentioned that recent change.
Right, that very important recent change we discussed earlier. Effective late 2024, first-time homebuyers buying any type of home, new or resale, can now qualify for up to a 30-year amortization on their high-ratio insured mortgage.
30 years for first-timers, even with less than 20% down.
Correct. It's a major policy shift aimed squarely at improving affordability for those entering the market by allowing them to spread payments over a longer period initially.
And for people who aren't first-time buyers but still have a high-ratio mortgage, what's their limit?
For repeat buyers or anyone not meeting the first-time buyer criteria, if they have a high-ratio mortgage, the maximum amortization generally remains capped at 25 years.
Okay, 25 years standard, 30 years for first-time buyers now. Got it. Now, what about the interest rates on these insured high-ratio mortgages? You said conventional rates are often slightly higher, so are high-ratio rates usually slightly lower?
Yes, that's generally the case, because the lender's risk is significantly reduced by that mandatory default insurance.
The insurer takes the hit if things go bad.
Right. The lender is largely protected. Because of that reduced risk, high-ratio mortgages often come with slightly lower interest rates compared to conventional mortgages for a similar term length. The insurance allows the lender to offer a slightly better rate.
Lower rate, but you have to pay the insurance premium, another trade-off.
Exactly. You might save a tiny bit on the interest rate, but you have the added cost of the insurance premium rolled into your loan.
Okay. And are there limits on the price of a home I can buy with a high-ratio mortgage? We know conventional is mandatory over $1.5 million.
Yes, there's a corresponding limit here, too. High-ratio insured mortgages are simply not available for properties valued at $1.5 million or more.
Same threshold.
Same threshold. If a home price hits that $1.5 million mark or goes above it, you must have at least 20% down and get a conventional mortgage. The insurance program is really designed to help facilitate homeownership for properties below that price point, assisting those with smaller down payments.
Okay, that makes sense. So we've covered the two main types based on down payment now. It might be helpful to just quickly recap the key differences side by side. Can we do a quick summary?
Absolutely. A table is probably the clearest way. Let's try this.
Okay, lay it on us.
Feature, minimum down payment, conventional, 20% or more, high ratio, less than 20% with specific minimums like 5% on the first $500, etc.
Got it.
Feature, loan-to-value LTV, conventional, 80% or less, high ratio, greater than 80%.
Okay.
Feature, mortgage default insurance, conventional, typically not leave-in required, high ratio, mandatory.
Big difference there.
Huge difference. Feature, maximum amortization, conventional, often up to 30-35 years, lender dependent, high ratio, generally 25 years, except now up to 30 years for eligible first-time buyers on any home.
Key change.
Crucial change. Feature, typical interest rate, conventional, often slightly higher, high ratio, often slightly lower due to insurance.
The counterintuitive one.
Yep. Feature, maximum property price, conventional, no hard limit, but you need 20% down for $1.5 million plus, high ratio, not available for properties $1.5 million or more.
Clear limit.
And finally, maybe primary benefit, conventional, avoids insurance costs, offers potential for longer amortization, high ratio, lower initial down payment needed to buy.
And the primary drawback.
Conventional, requires saving up a larger chunk of upfront capital, high ratio, mandatory insurance cost added to loan, generally shorter amortization for non-first-timers.
Wow, that table really lays it all out. It highlights those core trade-offs so clearly. It really seems like the fundamental choice boils down to how much cash you've managed to save for that down payment, doesn't it?
That's often the starting point, yes.
If you've got 20% or more, going conventional saves you the insurance premium, potentially lets you stretch payments longer if needed, though maybe at a slightly higher rate. But if you have less than 20%, the high ratio route gets you into the market sooner with less cash up front, but but you carry that insurance cost. And unless you're a first-time buyer taking advantage of the new 30-year option, you're likely looking at a 25-year repayment max.
That sums it up perfectly. And those recent government changes, raising the insured price cap to $1.05 extending amortization for first-timers, those are really significant adjustments impacting these decisions right now.
Definitely crucial context for anyone navigating the market today.
Absolutely. It's all about weighing your specific situation, your savings, your income, your comfort with risk, your long-term goals to figure out which path makes the most sense for you.
Well, this has been, I have to say, an incredibly thorough and really insightful deep dive into these foundational pieces of Canadian mortgages, especially clarifying that conventional versus high ratio distinction. I feel like it's demystified a lot of the core stuff.
That's the goal. Our main aim here is just to empower you with this knowledge. Seriously, understanding these fundamentals is the absolute first, most vital step towards making smart, confident choices about financing your home.
Couldn't agree more. And what's next? What other corners of the mortgage world can listeners look forward to exploring with us in future sessions?
Oh, plenty more to cover. In our upcoming deep dives, we'll get into other key ways mortgages differ, like the huge topic of fixed versus variable interest rates that they mean, the pros and cons of each.
Big decision there.
Massive. We'll also explore open versus closed mortgages and the flexibility they offer. We'll touch on more niche products too, like hybrid or convertible mortgages. And we'll even look at the qualification process itself, the stress test, all that, plus managing your mortgage once you have it.
Wow, okay. Lots more ground to cover. That all sounds absolutely fascinating. So, as we wrap up today's deep dive, maybe a final thought for everyone listening. Thinking about your own situation, whether you're planning for the future or maybe have a mortgage now, what specific aspect of all this? Maybe it's saving the down payment. Maybe it's the amortization length. Maybe it's understanding that insurance cost, what feels like the most critical factor influencing your home ownership journey right now.
That's a great question to ponder.
Something to reflect on as you navigate the sometimes complex world of Canadian mortgages. Thanks so much for tuning in today.